My channel. I'm Doris. I'm here to share with you about my stock account update. Today my stock account has earned $898. The market awaits for its inflation data. The Treasury Secretary Yellen said the U.S. economy is not expected to decline. In my account today, UNG made a gain of 3.07% to $7.06. In the post-market, it decreased for 0.57%. Unity Software rose for 0.4% today to $30.8, though still it has made a total loss of 3.56% in my account. Right now, the net asset of my account is $73,804.75. The market today closed mixed. The tech industries continued to close down. The Dow Jones Industrial Average closed up 0.29% to 33,684.79. Nasdaq Composite Index, due to its heavy position in the tech stocks, closed down 0.43%. The S&P 500 with a net loss of 0.00% to $4,108.94. Today, the software, infrastructure, and internet retail closed the lowest today, with a loss of 1.42% and 1.62% respectively. On the other hand, healthcare and oil and gas and the banking industries continue to make a gain recently of more than 1%. U.S. stocks closed mixed on Tuesday, awaiting inflation data, including Wednesday's CPI and Thursday's PPI, to gauge the chance of economic condition and a shift in the Fed's monetary policy. Cyclical stocks performed well, while the tech stocks lagged behind broader markets. Energy stocks led the S&P 500 index higher, with the sector up 0.9%. Tech stocks, on the other hand, lagged behind a broader index down 1%. Investors are watching U.S. inflation data this week, including Wednesday's CPI and Thursday's PPI. Both inflation measures could help investors further understand how the Fed will raise interest rates. William Northey, analyst at the United Bank Wealth Management, said, "The data this week is important because it'll be one of the last data before the Fed's meeting on May 3rd. And as the Fed evaluates its fight against inflation and the appropriate pace of monetary policy, market participants have begun to favor the Fed to raise interest rates further at its next meeting." He said, "This data will certainly provide new background to the Fed's assessment of their position in this battle." BOA analysts believe that the March CPI and PPI data will again confirm that U.S. inflation is more tricky. The Fed may not need to raise interest rates further to fight inflation, as the banking turmoil last month and the recent string of jobs data suggests the economy is slowing. New York Fed President William Williams said the recent banking turmoil was not caused by the Fed's aggressive rate hike. He thinks the problem with the SVB and the signature banks are special, while the banking system is generally healthy and liquid. U.S. stocks have entered the new earnings release season. Big banks such as J.P. Morgan Chase, Wells Fargo, and Citigroup will report on Friday. It'll be the first time the big U.S. banks have reported earnings since a series of banking crises erupted in March. Global investment agency Bucknet said, "I think this earnings season will be interesting, especially for the performance of large financial institutions and how they look at their current threat. Just last month, not did only several banks collapse, but lending standards have also been tightened early." He said, "I think this will provide a window into whether these banks will make any adjustments, at least in a seemingly much more optimistic environment than 3 months ago." The IMF released its latest World Economic Outlook report, which now expects the global economy to grow by 2.8% in 2023, compared with its previous forecast of 2.9%. Treasury Secretary Yellen, "The U.S. economy is not expected to decline." On Tuesday, Treasury Secretary Janet Yellen said inflation has eased over the past 6 months, and the U.S. economy is not expected to decline. Ms. Yellen made the remarks that as the World Bank and the International Monetary Fund held their spring meeting in Washington. The dramatic bankruptcies of Silicon Valley banks and signature banks in March raised concerns about the stability of the financial system. In the last 2 weeks of March on Friday, commercial loans plunged nearly $105 billion, the biggest drop in the data since statistics began in 1973. Among them, the top 25 banks fell by $23.5 billion. The remaining regions and small banks fell by $73.6 billion. And the foreign institutions fell by $7.5 billion. Janet Yellen said on Tuesday, "I see no signs of credit contraction, even though it is possible. The U.S. economy is clearly doing very well, with employment growing steadily, inflation falling gradually, and stronger consumer spending. So while there are still risks, I don't expect the economy to slide." Ms. Yellen noted that inflation remains high, but she saw encouraging signs that it has slowed over the past 6 months. The U.S. banking system remains sound, with strong capital and liquidity conditions. The global financial system has been able to remain resilient through major reforms after financial crisis. It is worth noting that media reports reported that Yellen has been on thin ice with the Biden administration because of her poor response to the banking crisis. Ms. Yellen's bullish outlook in the stark contrast to IMF's economic outlook for 2023, released on Tuesday. The IMF expects global growth to be 2.8% in 2023, a 0.1 percentage point cut from its January forecast, and a 3% in 2024. Down 0.1 percentage point from its January forecast. The IMF report also noted that the recent banking crisis in the US and Europe showed a greater than expected vulnerability of the banking system in the US and elsewhere, which could have a further impact on the global economy. In addition, French economy, finance and industry and digital sovereignty minister Bruno Le Maire also gave a more pessimistic view on Tuesday. He said, "With global economic growth slowing and ongoing inflation in many countries, we face a more difficult economic situation. Global growth should be below 3% in 2023, one of the weakest in decades, including COVID-19 and the 2008 financial crisis." That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.